Morning, students. Hope you are all doing well and you've gone through your notes of our last class. We started the topic analysis of account in our last class, and we look at what profit is, and we also look at ratios. We also look at measuring business performance, and under business performance or measuring business performance, we look at profitability ratios and liquidity ratios. And we just mentioned them in passing. We talk about gross profit margin, and we also talk about the profit margin or net profit margin and return on capital employed, ROCE in short. So profitability ratios are the ratios that shows how profitable the business has been in the year just ended. That's the accounting period of year, the accounting year. And we are going to be looking at three different profitability ratios. And we are starting with gross profit margin. This is a margin or a measure of profitability where it shows the percentage of revenue that exceeds the cost of goods sold, which means that the revenue you get from selling the products you produce must exceed the cost in producing those goods. So this gross profit margin shows or illustrates how successful a management team is in generating profit from the cost they have used in producing the product. So it's a way to also evaluate management. Okay, so how do we calculate gross profit margin? We have our formula. We have two formulas here. We have revenue minus cost of goods sold all over revenue times 100. We also have a second formula here, which is gross profit all over revenue times 100. Okay, for example, let's take this table that I put on the board. You see, we have revenue, gross profit, profit after interest and tax, or in other words, that's the net profit, and capital employed for 2012 and 2013. So if you are looking at this table, let's use the figures for 2012 to calculate gross profit margin. If you want to use this formula, the first formula, we cannot find cost of goods sold on the table. So, but we can find gross profit itself. So let's use the second formula. In case you are not given this, but you know you have to get the gross profit, you now use, in case you are given the cost of goods sold on the table without giving gross profit, you have to use the revenue and the cost of goods sold to get the gross profit, which means you subtract the cost of goods sold from revenue to get your gross profit. That is for the first formula. So we are going to use the second formula because we already have our gross profit on the table. So the gross profit is for 2012 is 189. The revenue for 2012 is 420 times 100. If you punch from your calculators, you see that we are going to have this answer 45.5%, which is our gross profit margin. Okay, I hope you is understood. If not, let me take it over again. This is our gross profit. We have gross profit here. We have our revenue here because we are using the figures for 2012. We can also use for 2013. So the figure for gross profit is 189 in 2012, which is this, and then our revenue is 420, which is times this. If you punch it, you have this answer, which gives us our gross profit margin. So let's look at profit margin or net profit margin. It is a percentage that shows the revenue remaining after all operating expenses, all taxes, all interest, all dividends have been paid, and what is left is now our net profit or profit margin, net profit margin. So it is a percentage of revenue remaining after all operating expenses, interest, taxes, dividends, etc. have been deducted from the total revenue. It means when you get the gross profit, you have to, gross profit is not yet the net profit, okay? From gross profit, you still have to subtract or deduct expenses, operating expenses. You have to maybe pay taxes, you have to pay dividends to the owners or the shareholders of the company, and when all of those things have been deducted, now you are left with your net profit or the profit margin, okay? Profit margin or net profit margin, okay? Now, this is our formula for calculating profit margin. We have profit all over revenue times 100. If we look at this same table, let's use the same table to calculate profit margin. We have profit 63, which is profit after interest and taxes, right? Which means this is not gross profit, it is the net profit, or what we call profit margin. We have it here, 63, which is 63 here, and the revenue is 420 times 100. If we punch it, we are going to have these figures. 15% of our profit margin. Then let's look at the third profitability ratio, which is return on capital employed. In short, ROCE, return on capital employed. What does it mean? This is a ratio that measures how efficient a company is or can generate profit from the capital they have put in the business, what they have invested in the business. So this ratio shows the investors how much each franc they have invested generates profit, okay? How much profit is generated from each franc they invested. So it is a profitability ratio that measures how efficiently a company can generate profit from its capital employed by comparing net operating profit to the capital employed. It means you compare your net profit, not the gross profit, the net profit to capital employed. And I said that it shows how many francs in profit each franc of capital invested generates, which means that how much profit does 1 franc generate from the money invested by the investors. And how is this calculated? We have the formula: profit over capital employed times 100. But in case you look on the table and you are not giving capital employed, but you are given assets and current liability, how will you get your capital employed? You can get your capital employed by subtracting current liability from total assets, okay? Current liability from total asset to get your capital employed. So, but we have been given our capital employed, which is 120 for 2012. We have our profit 63. So 63 on 120 times 100. If you punch it, it's going to give you 52.5%. So that's how we can calculate or measure the business performance using profitability ratios. In our subsequent lesson, we will be looking at liquidity ratios, and we mentioned that there are also two of them: current ratios and acid test ratios. So see you next class and stay blessed. Thank you.